Hi there, it's Isilia here from Tax World. Today, I'd like to talk to you about Section 80A of the Taxes Consolidation Act 1997. Section 80A introduces special tax rules for leasing companies that have income from leasing assets with a predictable lifespan of no more than 8 years. Normally, the gross lease payments would be treated as income, and there would be a capital allowance for the asset over 8 years, 12.5% each year. However, this could create a mismatch between the asset's useful life and the period over which it's written down for tax purposes. To avoid this mismatch, alternative treatments are available as described below. If an asset with a useful life of 3 years is leased for 3 years, the asset can be written down for tax purposes over that period. In this case, standard accounting rules are applied, no capital allowance is given for the asset, and the net income from leasing the asset is taxed. For accounting periods starting on or after the 1st of January 2010, a company within a group can choose to be taxed on the accounting profit from a lease. This relief applies to assets that qualify for a capital allowance and are leased for a short term, not exceeding 8 years. The income from such assets is not considered as arising from a trade of leasing. Until the 31st of December 2014, there was a limit on the wear and tear allowance that could be claimed, based on a formula taking into account various factors, including the cost of the assets and a group limit. The group limit was based on the total depreciation charge and other variables. From the 1st of January 2015 onwards, the wear and tear allowance claimed can be equal to the depreciation or amortization charged in the company's profit and loss account, but cannot exceed it. Two companies are considered part of the same group if one owns at least 51% of the other, or if both are 51% owned by a third company. However, shares held as trading stock are not counted. Additionally, the parent company must be entitled to 51% of the subsidiary's distributable profits and assets in case of liquidation. To be taxed on the accounting profit arising from short-term leasing, a company must make a claim by the self-assessment filing date. The claim applies to expenditure incurred on or after the first day of the accounting period covered by that return. I hope you found that useful, and I'll see you in the next video.